Welcome, if that's okay, Cal. Thanks everyone for joining. I think funding is one of the most important parts of a founder's and a startup's life. It is very complex and very time consuming, so I always love trying to share knowledge with the community around this. If we can help shorten up raises, get more raises done, then there's some really fantastic outcomes around that. And today, we're all very fortunate to have Lauren from Startmate here to present. This is a presentation that's largely, I hope you don't mind me sharing this, Lauren, being adapted from the Startmate cohort that Cake's currently in. And so Michael presented on this yesterday, and it's such awesome information. And look, to have Lauren with us, one of the great leaders of our community, is super awesome. So I'll do a little bit at the end about some of the nuts and bolts stuff that Cake sort of, gets involved with and tries to help with as well. But I think I'll hand over to Lauren. I think you have the ability to share screen.
I do, Lauren. Yes, I can jump straight in. So thank you so much for that intro, Jace. I will share my screen now. And bring this one up, but it's great to be here with you all. It's I guess the reason Startmate loves to do this presentation. Yes, we do it within the cohort, but this deck is something that's been built up over time through many different hands to really just help startups on that pitching journey. Because if you can get the pitch right, really what you're doing is getting the story of your business right. So it's less actually about are you going to raise money, and more about telling that really compelling narrative for your business. So I'm going to be running through quite quickly. There is a lot of kind of high-level wisdom to share, mainly around the process of crafting a compelling pitch deck to essentially get you that first meeting with your fundraising targets. And Jace will come in at the end to talk a bit more about the kind of how you get your house in order to actually start having these conversations. But we'll also, obviously open to having questions all the way through the presentation. So just use the chat function. Jace, I might need you to keep an eye on that as I'm presenting, because I'm sort of losing a bit of the ability to do both things. But happy to take questions in the middle of everything. And I might ask some questions and get some feedback through the process as well. But to start with, this is everything you wanted to know about pitching, but were too afraid to ask. These are the nitty-gritty points that it's unlikely anyone will share with you directly when you ask for feedback about your deck. Usually you're getting a yes/no pass for a meeting, but sometimes it's these very minor details that can actually make all the difference in getting you that next step. So there are 3 goals for this session today. The first is that we actually give you an actionable framework to create a better pitch deck, including some examples of really successful pitch decks from great companies across the world. The second goal is actually to give you a bit of an understanding of the mindset and motivations of venture capital. So often as founders, we are so lost in the world of building the business and so excited about what we have to do that we forget, to take on that mindset of a venture capital, a partner at a venture capital firm or one of their associates who are essentially seeing hundreds of deals a year, sometimes, more like 1,000, and are looking for some very specific signals in what they're pulling together. So, taking that mindset on and understanding what they're looking for is actually a big part of the process. And I guess goal number 3 is the realistic expectations you actually need about what the fundraising process will entail. It's unlikely that you'll ever send through a deck and somebody's going to wire you a check straight off the back of that. So this is a long-term investment in your company to even kickstart that fundraising process. So we'll talk a little bit about that as well. So as has been said by Jason and Cal, I am from Startmate. I'm principal there, and my role is really to help uncover the next generation of startup founders that we want to see coming through our accelerator program, like Jason and the team at Cake. And we also now run not just the accelerator program twice a year, but a range of other programs, including a talent fellowship specifically for women right now, but we'll be expanding that further this year to include students and engineers as other kind of key verticals. And our First Believers program, which we've just launched, helping people embark on the journey of being an angel investor. So, perhaps over time, you'll end up bumping into one of our first believers and sending this pitch deck to them. So we're trying to build out the ecosystem with that in mind. So Startmate is the epicenter for startup ambition across Australia and New Zealand, as I said, from a founder perspective, from a talent perspective, from an investor perspective. And over the last 10 years, we've made 150 investments of $75,000, with that portfolio valuation collectively being more than $1 billion. So the value of each of those companies in their own right today. So we've seen a lot of decks, of course. To get those 150 investments, we've seen hundreds and hundreds, thousands of applications and decks over time. So, the team over this period of time has certainly built up a lot of that knowledge and experience. And similarly, any of the VCs that you have on your target list around Australia will be seeing 1,000 pitch decks a year as a kind of very rough number, whether that's just cold emails, whether that's companies that are being sent to them. So to be able to cut above the noise, or even get a proper look in to have somebody look at your deck properly, there are some pretty high level tips that we want to see you kind of incorporate into your thinking about creating the deck, which I will go through today. Because of course, each partner is essentially making only 1 to 2 investments per year. So in that noise of decks, you need to get to the meeting, which then of course puts you in line for being one of those investments that they might make. And any of you who have actually already embarked on that fundraising journey, you will know that it is a full-time job in its own right. And while it takes this really long process, of course, every investor out there really wants you to be focused on the business, not on fundraising. So while you need to understand what you're in for when you kick off that fundraising journey, you certainly, you need to make sure you're keeping an eye on the business that's being built in the background as you go. But just, when you embark on this process, you definitely want to have that front of center. And what we, as I said at the beginning, are hoping to do with this particular presentation is at least get you fast tracked to that first meeting that you can have with as many of those targets that you've identified as possible. And of course, if you are building a business for the long term, this isn't the first or only time you will be fundraising. This is something that you're going to be doing over and over again. Fundraising, building the company, fundraising, building the company. But that first fundraising process will always be the hardest, especially when you're building up your reputation and knowledge of the venture capital ecosystem in and of itself. But of course, every later stage that you raise, there'll be a whole different tier of venture capitalists that you're looking to speak with, who are growth stage companies, who back growth stage companies, or later stage investment rounds as well, or global overseas investors as well. So there's always something new to learn, and the sophistication of that initial deck will evolve over time as well. And of course, as I said, building a company is the important part, but we do want you to get these meetings so that fundraising enables you to fill the tank to get to that next milestone in the journey. So let's get into what the pitch deck actually should look like, and how you can convert that deck into the meeting that will help you fill that tank. So today we're talking specifically about marketing decks. Of course, you will have seen other kinds of, more extensive decks, which are more likely for board presentations that go into the depth of the financials, or maybe as a follow-up, you might prepare something a bit more extensive for those investor conversations. But this deck that we're talking about today is the foot in the door deck. So we're going to talk about that at a really high level. In a nutshell, these decks should really be 8 to 10 slides max. They should be a PDF, and they should be sent via email. But actually what's interesting is there are some really new tools that can actually help speed up this process even further, and perhaps give you an edge when you're talking to investors as well. Companies like Loom, which you might have heard of, or which is another app where you can basically walk through a presentation yourself and send a short video, which could even shortcut the process and help an investor get a sense of you as a founder, while also understanding the business that you're essentially pitching. But in a nutshell, you want this deck to be super clear, super quick to pass, and ultimately lead to the conversion of the meeting. And that's just an example of one of our portfolio companies, Propeller Aero. You can see it's super bold, visually compelling, and uses, I guess, font and text size to its advantage. The basics that you need to consider here, especially in the early part of the deck, is that you want to ensure you're including your email address and phone number prominently. If this is a tool of information, you want people to know how they can contact you straight away after reading the deck. It's amazing when decks get shared or forwarded on, the initial email contact can get lost in the process, and some people just forget to actually include their own information on the deck. So just a word of wisdom here to make sure that it's somewhere in the deck for people to contact you. Don't do legal disclaimers, NDAs, this sort of thing. You know, it probably presents as a bit naive, especially in these early conversations with investors. You don't want to put people off by thinking that there's, you know, some kind of legal challenge that they could be entered into off the back of this deck. And the fact of the matter is that investors see so many pitch decks and speak to so many companies through the course of a year that they are just never in a position to be able to, you know, sign an NDA or anything like that, because it basically would render their whole business, you know, impossible to do, because they're always going to be speaking to competitive companies. If anything, you know, if the legal concerns that you might have are there, you would at least just write confidential on your deck, but don't sort of get into the process of trying to get people to sign documentation to suggest that you know, they wouldn't share any of the information. At the end of the day, this particular deck wouldn't necessarily contain any information that should create conflict or you know, put your business model at risk at the end of the day. Third point here is make your headers tell the story. So again, so often we use all of the real estate available to us in the pitch deck. We don't enable the reader. Sorry, my daughter is knocking on the door behind me. We don't enable the reader to have their attention drawn to the key messages that are on the page. Instead, we try to give them as much information as possible to read through, which is going to you know, create problems and mean that people aren't really familiar with what they need to be paying attention to. So as you can see here with this example, that top line, if that was all the investor read, they would still have a good understanding of what this business does. eShares is capturing the next generation of IPOs and their shareholders' brokerage accounts. 2 lines says it all, and they've used an image to kind of demonstrate you know, what that landscape actually looks like. Again, just top line with a qualifying statement is all you really need to do here. And it really does give people a sense of the narrative running across the top of the page. So even if they flick through that deck really quickly, they would be able to get a sense of the whole deck all at once. The fourth point here, you know, it almost seems like a bit of a no-brainer in this time, because there are so many wonderful tools that enable people to create professional looking documents without a lot of expense, or even without even having to hire somebody to do that for you. But we do always recommend the design of the deck as being important. It doesn't need to be fancy or complex. It's just that it has an aesthetic sensibility that makes it easy and a pleasure to read. As it says here, readers are grateful when something is nicely designed. Grateful means they're more likely to read it. And if they're more likely to read it, they're more likely to actually want to meet you at the end of the process. So, you know, skill up on Canva quickly. You know, even some of the basic Office and you know, Keynote kind of software really have a lot of inbuilt skills these days that enable you to make something nicely designed, but definitely lean on some of that expertise. And of course, the conversion is getting the meeting. So that's ultimately what we're aiming for here. Use numbers, not adjectives. Again, I think when we're in the early days of raising money, it's so attractive to try to tell a big and ambitious story and talk, you know, in flowery adjectives and big words, and actually hide from the numbers because they feel so small. But really, this is your opportunity to set a baseline in terms of where your company's at, and you know, perhaps show some of this initial traction, which is going to tell the story. So whatever numbers you have at your disposal, you know, they may not be revenue numbers. That's not necessarily what investors are looking for all the time, but you need to use numbers to your advantage so that people can actually follow, you know, the trajectory of your business from that traction perspective. Similarly, infographics. If you're going to leverage numbers in some way, make sure it actually adds to the equation. Infographics should simplify things, not confuse things. So don't feel the need to get too complex with how you present the information. You just need some very simple metrics that people can follow along with. Number 7 obviously feels like a basic one, but we're also surprised, you know, when you're reading something over and over again, the words all start to blur together, and it's hard to see mistakes, especially when you've got multiple hands editing. So definitely take the time, have somebody do a last check of your document to make sure your spelling is correct and there's no obvious typos or errors. Even just format wise, sometimes things move around on the page and you want to actually get you know, somebody to check some of those inconsistencies as well. And number 8, no more than 20 words per slide. this can be also something that's really challenging for people to stick with, especially when they feel like they need to use this deck to tell everything about the business, because they may not get a chance to talk to somebody face to face. But often it has the opposite effect, where too many words on the slide means that none of the words are actually being written. It's being flicked through and sort of put to the side. So you really want to work hard to think about what those 20 words might be, and how you might support that with other visuals, or even just white space on the page will actually draw more attention to the impact of what you're trying to say. And finally, nailing the first slide is really key. This is the thing that's going to actually make them turn the page. Sometimes we overlook the importance of what this slide should be doing for us, how hard it should be working. But at the same time, we don't want to make it overly complex either. So all it really needs to do is tell what your business does in one line, and point to how somebody can get in contact with you. If that if that one-liner is crisp and clear enough, and creates a compelling story and is beautifully presented, it may be the case that somebody knows right there on the spot that they need to reach out and have a further conversation. So that's been a lot of information just to start with, but I wanted to encourage all of you who are on the call now. We have about 60 people. Maybe just take a minute and jump into the chat and write what your one-liner is for the business that you're working on. It would be really cool to see what everyone's up to, and maybe you can practice this kind of elevator pitch within the chat here. So jump in there and do that, and maybe we can call some out later as we go. So there's just an example of what a good first slide might look like. It's very stripped back, obviously. You can make it look a bit more visually compelling than this, but it's going to give you the information that you really need. And on this point, in terms of the one-liners, you know, it's so much harder to say something simply than it is to write a long paragraph about it. And this is the eternal challenge for startup founders who are only going to have minutes to kind of pitch the investor that they bump into at an event, or, you know, a minute, even 10 seconds at a glance on a page to get somebody to invest further in what you're doing, and read the document. So if you can't explain it simply, you can't explain it at all. This is, you know, something to keep in mind around how complex things need to be reduced to something so simple, but can still have a lot of impact in and of itself. So really work on that one-liner statement and practice it with different people as well to see how it resonates. Put another way, you know, if you had more time, you would write a shorter letter. This is something that I experience in my own professional life. I love long form writing, but it's so much more time consuming to actually write something that's short, brief, to the point. But those things always have more impact. So it's a good skill to get in the habit of for lots of different reasons, not just for pitches. I can see lots of one-liners being shared. That's great. Jace, I can't check the chat while I'm in presenter mode. Do you want to call out a couple of one-liners that you're seeing there? You're just on mute right now.
Yeah, there's some great ones coming through. We make group payments easy peasy from Yana. Peter from Extraterrestrial Power says, let's power up the solar system. We are working on solar cells, satellites, and later manufacturing them on the moon. Nice.
Amazing.
That's huge. What about,
that's cool.
First up was Bimble. They're transforming the next generation of accelerated human learning.
Love that.
Awesome.
Thanks, guys, for sharing. That's really cool. I hope you're getting some inspiration from each other's as well. And again, just to point to some examples in the wild, you know, the vision for Microsoft back in the day, really simply, a computer on every desk and in every home. Something like this seems like a no-brainer today because it actually has occurred almost 3 times over, considering how many devices we all actually have. But at the time, that was just a really clear vision for what they were trying to achieve. So if you think about those 9 tips all come together, the marketing deck is actually a test. It's a test that the investor is looking to see you pass. Are you a captivating, clear storyteller? So we've seen some great one-liners in the chat. This is the first test that you're looking to pass with that one-liner. The best storytellers ultimately get the best investors, they get the best customers and the best employees. So it's not just about getting this deck read, it's actually thinking about how you as a founder are able to build the company to be the success that it's needing to be. So that storytelling and narrative development will become a through line across your entire founder journey. And now it's never too early to start working on crafting that narrative. So with those 9 tips in mind, there are some key slides you want to think about including in your deck to make sure that all of the key information is actually being shared with the investor. And then there's a couple of bonus slides that you might kind of pick and choose from depending on the story that you're trying to tell. So the first slide obviously is the ambition slide. Apart from that kind of one-liner first page, this ambition slide is going to set you up and hook the investor in with the grand vision of what you're trying to do. And it's really important here that you stay within the realm of reality, but also just show how expansive your thinking can be. We want to be able to see the line from where you are today to where you're going to get to. So this is usually a mission or a vision statement, and it also captures the specifics of what your company does to address that mission or vision. An example here, bringing healthier and more affordable food to everyone, everywhere, a nice crisp vision. Help the world learns from its data, a company's mission there. And really this speaks to the venture capital mindset point that I mentioned at the start of this presentation. What the venture capitalist is trying to assess at this point when looking at your ambition slide is, can my 10 to 20% ownership in this company return my fund? So of course, venture capitalists are making many investments from a particular fund, but they know when they make those investments that only 1 or 2 or 3 of those, perhaps 10 investments will actually, turn into the returner, as they say in the industry, that will actually bring back all the amount that they invested and some, and potentially cover the whole fund. This is called the VC power law. So while it's not every company's path to actually do that, a venture capitalist needs to know that there is kind of line of sight to that being a possibility for every company that they're investing in. I should pause there and just mention that, of course, venture capital is only one path, and more every day, we're seeing a huge range of options available for founders in the Australian and the New Zealand ecosystem as well, that don't all look like venture capital returns. But I think everyone's looking for this ambition, even if it's not looking at the VC power law return. Everyone wants to see that you're, taking a sizable and important problem and dedicating yourself to it, because that also speaks to founder motivation as well. So this mission or vision statement should speak to an outcome that can be measured in the billions. If we're talking about VC in that context, they want to see how they can turn that $5 million investment into $50 million in return. Small and large missions are equally difficult to execute, but large missions obviously attract the best people. So again, a small vision is noble and worthwhile and probably a good business to be running. But if you're trying to build a company, of the size of some of the larger tech startups in the world these days and attract kind of venture capital funding to help you achieve those goals, those large mission statements are going to be the things that really catalyze that growth. Apart from the ambition slide, the team slide is probably the next most critical slide and often the most underdone or over complex. So you really want to make the team slide A++, and in a very short snapshot, explain why this group of people who's assembled right now is going to not only deliver on that mission, but much more. So the investor's mind. Sorry, Jace, yeah.
I've got a question here that relates to the previous slide about the 10 to 20% investment returning the whole fund.
Yep.
And I think it's a really important topic for founders, especially newer founders, to understand. The question is a 10 times plus return on a smaller VC investment more important than striving to be a unicorn? So, I'll paraphrase that a little bit, but I think what Nick's trying to understand there is, I guess, is 10 times enough, or does it need to be, 100 times? What are they really looking for when making these investments?
Good question. And I think it is actually related to the stage that the investment is happening, because if you think about, many of you are perhaps at seed stage, many of you might even just be at the pre-seed angel investment stage. And there's actually different metrics again for each of those stages. An angel investor might only need a 3 times return on their money to have made a really attractive investment. A seed investor, you're looking at maybe 5 to 10 times. But as you get into the growth stage investing, they just need that multiple to look much larger, because, you know, the money going in is larger, and then the kind of multiple on growth is always going to trend in the direction of a unicorn, as you say. So you need to get past that unicorn threshold to even, you know, make that investment return feasible. So it's not necessarily about chasing unicorns always in every way, but certainly there's a stage at which, if you can't see a line of sight towards $1 billion valuation in this current market, then you're probably going to be falling short of a particular investor group's expectations. Hopefully that helps.
When you're going out and pitching, you know, if you're in a market that isn't that big and you want to be a unicorn, then you need to find a bigger market. Or then you just go and find different types of investors that have, you know, different, you know, objectives with their ROI and their fund.
That's right.
Just know that if you're going to go and spend months presenting to VCs, because it can take a really long time, or you know, probably get a lot of no's if you can, small, so it won't take that long. But you know, like, it's going to take you a month or two to prepare that deck and get ready and go and do all that marketing, and you're not going to get the outcome you're looking for. So it is really important to know
absolutely
on that front before you start marketing your investment.
Absolutely. And I think this is a unique challenge for Australian and New Zealand startups across the region, really, in terms of the size of our home market. And, you know, what does it mean if you are trying to capture the Australian market or a percentage of, versus actually going after a global market from the get-go? So the question of, if you're going after a global market from the get-go, how can you feasibly achieve that in a short period of time, because there will be competition from overseas. So you need to believe that it's possible, you know, in 2 years to have gained market share. If you look at something like Afterpay, who's had this phenomenal success, not just in capturing the Australian market, but then making a really significant dent in the kind of global buy now, pay later landscape. So they needed to believe that was possible from the get-go, but that the market size of Australia actually could have been attractive enough in its own right if they were just focusing there as well. Great questions. Thanks. Keep them coming in, and Jace can interrupt me anytime. But yes, back to this slide, I guess the team slide is, do I want to spend an hour of my time with this person? And that seems like a funny way to frame it, but as I'm sure you've heard said, an investment or a venture capital relationship for a founder is as close to a marriage as you're going to get in this day and age. This is sometimes a 10-year relationship that will go through many highs, many lows, many empty bank accounts, many lost customers, co-founder challenges, investor and founder challenges. All of this is a relationship dynamic at the end of the day. And the team slide is about selling you and your team as people who are worth kind of, you know, getting to know and spending the time to learn how to support them as much as anything. So yeah, worth keeping in mind. Some common mistakes that happen here, which it's funny when you're on one side of the table as a founder, it might feel very, you know, compelling to do this because it looks like you're, you know, really showing how much experience is at the table, or, you know, how competent you all are. But sometimes it looks like overcompensating, or, you know, just making something too complex, more complex than it needs to be. So things like adding up the years of experience, when you see, you know, 50 years of SaaS experience, because the team has equally, you know, five founders who've worked in SaaS for 10 years, suddenly equals 50 years of SaaS, which of course is not even possible. So that's a big no-no. Especially when it gets to like 100 years of something, it's just quite amusing. Forgetting logos of past experience. I think, you know, relying on words, especially at this stage in the deck, you should be leveraging employer logos of companies that your team might have worked at in the past to gain credibility. Underselling yourself in reverse can be a problem. You know, not really justifying why you have a unique insight that will address this. Anything cute, like just don't play around with the team slide. It should be just clear and simple and reflect the professional standard that you're hoping to present. Too many adjectives, not enough numbers. Let's talk about growth or success in different, you know, previous experience, as opposed to, you know, how good somebody is from a descriptive perspective. LinkedIn URLs can be helpful. Too many people on the team slide. Often you'll have a party of 6 or 7 and it's just getting a little intense. Really just think about co-founders being profiled, and then maybe some subject matter expertise, or you know, people who are across the team at a kind of senior level who have this pedigree that you think is worth displaying, but only full-time staff members, not advisors who kind of drop in and out. I think it's really important at this point that you're presenting the team who's around the table every day to get the job done. A great example here from Danielle Morrill, and these guys. Actually, now I've blanked on the Mattermark was the company that they founded. But you can see here they've leveraged logos, they've given a visual of the founders, and talked really tactically about their experience and what they actually achieved in those roles as well. The traction slide, the third key slide that you want to include. Again, this is about numbers. You want to be able to show traction in some way, shape, or form from where you started to where you are now. This doesn't have to be revenue, and it doesn't have to be in the thousands or the millions. It just has to show the kind of upwards and to the right direction of growth that investors will be looking for. So small numbers are better than no numbers. Let's be honest about where you're at, but show how you plan to kind of reach that next milestone. This is an old adage, or old, I mean, in the startup industry adage, good news comes in numbers, bad news comes in words. So the more somebody's talking to something, especially in investor updates and things like that, there's a lot of descriptions about this happening and that happening. Whereas the good news is always like, we nailed this milestone, you know, X many customers onboarded, all that sort of stuff. So it's an easy tell to an experienced eye. So for the traction slide, you're picking dollars or users. Again, if you're not charging for your product, you're obviously focusing on customer growth, traction, virality, whatever it might be that shows you found a sticky niche in the market. And, you know, in terms of revenue, what they're ultimately looking for as an investor is to see that you can get to $1 million of revenue within 1 to 2 years, ideally without having had funding come through. So how can you bootstrap your way to that point before you are looking to fill the tank and reach that next milestone? Some just examples of the traction slide that you might include, showing that up and to the right direction. Daily signups was the customer metric that Coinbase is focusing on here, how many new members are joining the platform, and then transaction volume as a separate metric, which is pretty compelling as well. Again, just a blank monthly recurring revenue showing that there's just steady growth month on month over time. 2 slides you'll almost certainly need, a clear articulation of your customer's problem. What are you actually trying to solve? And then why your solution kind of fits into that problem so neatly, or why you have you know, unique expertise as to how to solve that problem. So here is a clear example of the problem. Most of the world will make decisions by either guessing or using their gut. They will be either lucky or wrong. That's a big problem, and this company is going to solve that. Here's another version of that, a similar problem. 6 slides to consider adding once you've got your team slide, your traction slide, your ambition slide, your problem slide, and your solution slide. These are all optional when you think about the composition of your deck. You want to lean into the ones that are going to pull the most weight for you, do the most hard work. A clear articulation of your business model, if it's not already blatantly obvious. If you're a SaaS platform that will be charging subscription revenue, this is probably not necessary. It's an obvious thing to point out. But if your business model is almost category creating in its own right, something that hasn't been done before, you want to use perhaps a visual to demonstrate the flows and where you're actually making the money. But ideally, you're only settling on one business model, not multiple intricate models that all stitch together, because likely that will be a flag or a red herring. Here's some examples, charging per transaction and how that gets broken down, or where that's likely to come from. And perhaps here, what's interesting is they've given a justification as to why they've settled on that model. So it demonstrates that they may have experimented and landed on something that really works. So that's also an interesting way to think about this slide. Quantifying the size of your total available market. Now, this is quite contentious. It's usually pie in the sky. It's usually impossible to justify how you can actually obtain a segment of that market. And some investors, there was even a Twitter thread yesterday that Nikki Shivak leveraged off from a US VC, but you know, talking about the fact that TAM is probably one of the most useless indicators for a venture capital decision. Other investors will really rely on it. As you get later into the growth stage investing and the market becomes more clear, there can be, you know, it can be worthwhile to lean into this. But if you are at really early stages and you're talking about, getting the whole consumer social market, 10% of the consumer social market, that's going to be a bit of a kind of random calculation to do. Jace?
Yeah, I think this is one of the hardest ones for early stage founders, because so many angels really dig into this, and founders really never have any idea, and then they try and tell the really big picture story, capturing a small percentage of a really big market, and then that can seem really, I guess, insincere, and so it is a really challenging one to cover, because you kind of do need to cover it, but at the same time, you never really know. And as you say, like, great teams and great founders find a market as they grow, and there's many as well. So I think it's an area that if people should probably spend as much time as they can on really understanding and getting the nuance right with their pitch, and just practicing it again and again. We often talk about investor readiness, and a big part of that is just testing these keys. Like, if you're going to have a key slide in your deck and you're not really sure you're hitting the mark, go out and test it a little bit as well, because you can get some good feedback. It wasn't so much of a question, just no,
it's a good point. And actually, you're right. A lot of angels will almost over-index on this as well, because they're making, a single investment from their own personal funds. They are at risk when they do that, so they really want to understand what this looks like. I think the more sophisticated way to approach it is to understand the markets that your business sits within. Yes, it's the total size of those markets is attractive, but especially when you're in a category creation role, like you're doing something that hasn't existed before. How did Airbnb quantify the TAM of peer-to-peer accommodation in the early days? It would have just been a total guess, looking at travel and business travel perhaps as a total market, but how to estimate a size of that share would have been completely pie in the sky back in the day. But at least understanding the markets that you're playing in is useful.
We've also got a question from Joshua. He says, we have at least 3 patents. We are pre-seed angel stage. Should we move to the US to get access to the 330 million people there, or with the same patents, utilize it in a country like Australia with 23 million people? Any sort of comments on that, Lauren?
It's a good question. I guess, without understanding too much more about the business, I would wonder why you would need to pick a market in that. So I guess it would be good to dig into why you need to pick a market, as opposed to just being able to offer what you're doing globally. I would say it's possible to launch a business globally from Australia now more than ever, so that the relocation piece may or may not be important. There's a kind of a window in time where you should be potentially having a global mandate from day one right here at home. But yeah, it's a little bit of a challenging one to answer in too much detail without knowing more. But I guess with the patents and the confidentiality, that's also going to be difficult for an initial conversation to understand.
Well, I love the global from day one if you can. And
that's it.
We're trying to work that out at the moment. Pretty cool thing to go through. Thanks, Josh.
Absolutely. Thank you for the question.
Just a couple of other questions too, Lauren. Just a quick one about, would you add video or animation to a slide deck?
I would only do it. Look, I wouldn't necessarily add animation or anything too complicated. Basically, anything that you do like that is asking for more time. The benefit of something like Loom that I mentioned before, where you're actually walking through your pitch deck, is it actually gives the investor control to speed up the process and actually walk through the deck in half as long, and give them a quick overview. Whereas any other additional materials, you're actually asking them to spend more time and maybe save that for a follow-up.
Cool.
Awesome. I'll just quickly run through the remainder here, and then I think we'll just jump into more Q&A. Unit economics, this is really, again, the metrics of how your business might work. It may be worth, in terms of whatever business you're doing, to dive a little bit further into this. But again, it's going to be specifically relevant for some businesses more than others. The why you slide, if it isn't clear from the team slide, it can be worth a clear statement as to why you are genuinely positioned to take advantage of this market. What kind of skills and knowledge do you have that competitors don't? And I'm just going to flick through this, and the why now slide, which is a good place to leave it. Ideally, you want to be again harnessing a window in time, taking advantage of a unique moment, a unique skill set, a unique tailwind that you can leverage. So where this is a useful thing to leave the investor to think about, especially if it's a thesis that they're actually watching themselves and understand more deeply. And finally, the ask: how much money are you actually raising, and where will it get you to? You don't need to set the price that you're raising the round at, but you want to tell a compelling story for why the next 12 months, with the money that you're raising, you'll be able to get through to that 12-month milestone and achieve the next range of milestones off the back of that. So I might leave it there, and maybe we can jump into a bit more questions, but Jace would love to also dive into a bit more of once you get to this point, what do they need to be thinking about as well?
Awesome, that was amazing. I had some great takeaways. I love the reference to Carter, one of Cake's biggest global competitors. Startup life just never stops awesome and intriguing moments for you. Making a visually compelling deck, I think, super interesting. Lots of people skip over that, but I think it's so important. Branding and being able to sort of show yourself in the best light is, like, really critical, and quite a simple one to do as well. So that was awesome. Using numbers, not adjectives. I think we've been guilty of that in the past, especially on that traction slide. I've been pulled up on that before, and so don't do that to yourself. I can definitely account for that. I also really love the small and large missions are equally hard to execute. When you're really pounding away in a startup and you're thinking, oh my God, can I really go on and build $1 billion company? It just can feel like a lot, but you just got to think, if you have a normal job or if you go for a small company, they're really hard things to do too in most cases. So I think choose the biggest challenge you can. I think that's a really wonderful bit of insight as well. Thanks for that. So we did promise a couple of things on the technical aspects. So I'm just going to do that for a moment. I'll try and keep it reasonably short so we've got time for more questions. And if you've got questions, please put them in the chat, because then, we can gauge how we sort of wrap up into the end of the hour based on the questions that we have coming through. I can't see the questions now, Cal, so maybe you can help me now. Cool. So at Cake, this is our sort of tagline. So we help, this is a bit of a vision and a tagline thing together, but so we help great people build a better world by making equity simple and fast. How we do that is by streamlining and simplifying capital raises and employee share option plans and the cap table. We're going to talk a bit about that now, because it's amazing how much you can speed up your round and even raise more if you get this cap table stuff right. Like, you quite often don't think of it like that, but it's actually what you're doing is selling part of your equity, which comes off your cap table. So if you're not prepared properly, if you make mistakes, it can cost yourself, a huge amount of money, control of your company, a huge delay. You can even block and kill your raise with errors around your cap table. So it's really important to be across this stuff. Most of the people we work with are in this really early stage up to sort of Series A, and we do have some sort of Series B and C companies. So a lot of this stuff is designed for the earliest companies, which I presume there'll be a lot of here. There is a lot of capital out there in the later stage. It's just been going up and up and up over time. So it's really worth putting the effort in, to get there. It is important to be aware that we're raising in tough conditions. This is a slide that I borrowed from one of the global leaders in our industry. It's not to say you can't raise capital, because you definitely can, but you just need to be aware to cast a wider net, be more prepared, position yourself better than the alternatives, and make sure that you just allow yourself a little bit longer, because you don't want to run out of runway just by underestimating how long it's going to take. It's really, really important. This is just a quick one for, I guess, earlier stage founders, just so you understand, like, there is a market out there. You can't just go out into the startup land with whatever value you want and raise however much money you want. I mean, I guess you can, but you're just going to make life really hard for yourself. So be aware that, if you're pre-seed, just keep your valuation in this range, know how much you can raise. You want to be diluted, 10 or 20% each round. But also be aware that sometimes getting to Series A, that's only one round. And as Lauren said, ideally you want to bootstrap there, which is rarer. But, if you raise 3 rounds before you get to your real Series A, then you're going to have a really cooked cap table, which I have something similar to, I must admit. But, we got there as best we could at Cake from the Gold Coast. So we've got a couple of rounds, and, so we've but we did keep the dilution. We tried to put the seed and pre-seed together into one round, which made it overall a good outcome. But you don't want to get diluted too much. You don't want to get diluted too little, really important. And don't forget your ESOP. You do need to allocate 10% of your ESOP. You need to understand how you're going to get that into your cap table as well. A lot of people aren't that great at maths, and can be really confusing. And some people are going to look at this and go, oh, this is really easy, but bear with me. So each round you do, you're going to have less equity in your own company, which can be really scary, especially for people that aren't that familiar with finance and aren't that familiar with, really having investors to work with in partnership. And it can seem like a really difficult thing to get over, but it's quite simple. Really, the objective is to have a small slice of a big cake that's worth a lot, down the track, rather than, having the whole cake, a really small cake. And most startups need funding to grow really quickly and capture that market share. And quite often it can be a winner takes all market. And without that capital, it can be really challenging to go and take those strong positions that are defensible over the long term without capital. So you do need to understand that you're going to be diluted over time, but as the company gets more and more valuable, the value of your shares goes up. Lawrence talked to this. You need to understand that investors want about 100% return every year. So you need to sort of show, I'm going to go from 2 million to 4 million to 8 million to 16 million. And of course, it's not that linear, but you need to know that they're thinking that, and you need to be able to show that progression. Otherwise, it's going to be difficult to get investment. As you progress, the annual return can come down because the risk is reducing. So Series A, Series B, C, you're looking for lower annual returns, maybe in the 50 to 70%. And, now that there's no return in lots of other sectors, perhaps it's a bit better now, but just good to have these rules of thumb in place. And the big picture story that Lauren talked about, 10 to 20 times plus now, 20 to 100 times is really where you've got to be able to understand that that's available for you and your industry and where you're going, to be able to get those investment discussions moving. This is a more about how to execute. So what I see quite often is people just don't quite think of it in the right way. You need to understand that you're making a product, and that product is your company's equity, and then you need to market it, and then you need to do a sales campaign. So what I mean by that is, don't just go out there and market to anybody. Know who you're going to pitch, know they invest in your industry at your stage. So you're getting into the right rooms, and I'm sure you've all heard the term, just, pitching in the right room is half the challenge. So get into the right rooms, talk to the right people, make sure you've got enough. Like if you need 10 investors, make sure you've got 40 or 50 on your list. Otherwise, you're probably going to set yourself up for a hard time. Ideally, you want just a handful of investors, but it doesn't always work out that way. Be the next best alternative. So really try and set yourself up so that you're removing all the blockers and you're setting yourself up for success. And then make sure you close your round. So make sure you put time pressure on it. So when you really open up, so you might be doing marketing for a while and then you're ready to run your round, you've got the feedback that it's strong and it's ready to go. Set a time frame on it, put clear parameters around it. It really does improve your chances of success. I've seen many founders follow, investors around for a long, long time and never really actually ask a question like, well, we're raising now, would you invest? Like if you'd never ask, you're going to have a difficult time getting a yes. All right, so some technical stuff is really, really important. It's really hard, unfortunately, especially for non-finance and legal people. Kate does streamline a lot of this, but like you've got to understand all the term sheet terms, and you've got to understand what a con note is versus a safe, and you've got to understand the dilution around your cap table and these sorts of things. If you don't, it can cost you millions in an exit. It can cost you control of your company. It's really, really important stuff. Quickly on a con note or a safe. Convertible notes and safes are really popular. If you're not running an equity round, which is like I'm selling 10% of the shares in my company for X dollars, these are the natural alternatives. There's also other funding channels now like venture debt and things like that, but these are the most common alternatives. They are, in general terms, cheaper and faster and easier to implement. They don't have as much legal cost normally. They don't have to be all settled on the same day. You can run rolling closes. Quite often the valuation is taken out of the equation at that point, which can be very, very helpful.
You need to be a bit careful on the other side too. If you've got too many con notes and safes, you can get yourself a bit stitched up from dilution later. You can also then potentially have a down round later with a con note and a safe attached to it, which can be really heavily dilutive. So you do need to be a bit careful about how much you take in notes and safes, but really cool instruments in some ways and well worth considering. With an actual equity round, you need to understand these terms. When we did our last round, I literally sat down for 3-hour-long sessions with my co-founders and my incoming director just to talk through all of these. And it is that kind of level of complexity. Each one of them doesn't feel good. It just is hard and it's attached to some other thing. And some of them are really painful. And I hear some founders, in my opinion, kind of naively complaining about it all. And I wish people would just get over it, because this is the way it is. It's like you don't go to the bank and go, oh, I don't like all these things. You know, like I think as an industry, we kind of need to get with the program on these. Of course, you can negotiate some, but normally when you get to the next round, you've got to put it in there anyway. But yeah, so get used to these, learn them, understand them, make them work for you, and just don't make mistakes. You know, like understand who gets a board seat and how they get the board seat, and make sure you've always got one at least if you can't, you know, control who else is on the board. You know, understand drag alongs, tag alongs. I mean, even founder vesting, it can be really hard. You've already vested your shares and then you've got to have them revested. But think about it, like you're getting a lot of money and the investors want to know you're going to be there for the long term. So it's really, really important. Some red flags though, it's probably investors on the call. Like you don't want to have big liquidation preferences there. Ideally, like anything 2 times, 3 times, especially if it's participating. I won't go into that now. Like that can really cook you on the exits later. But in some circumstances, it's just the way it is. And I don't want to qualify, or need to qualify a little bit. In some circumstances, that's a fine deal as well.
I was also just going to jump in there, Jason, say like there was a time in Australian venture capital where terms like this did crop up, and there's probably like an older league of investors where you do have to be careful because it was more the norm than the exception, but now it should absolutely be the exception than any kind of liquidation preferences are included like this.
Totally, yeah. 1 times non-participating is totally fine, and it's a fair clause. And then anything after that really needs to be like a strong negotiation. Sometimes if you need a really big val, like just say you needed to raise 20 million at 100 million or pre-rev, like sometimes you get these big liquidation preferences in a balance against that. But there's not too many circumstances where that's happening at the moment, which is good for founders. Anyway, it swings and roundabouts. But yeah, option pool size, make sure you get your model done correctly. So make sure you understand, look, if I get 10% dilution now, what about my seed round? What about my Series A round? Like, look at the 3 rounds together, kind of understand how much dilution there's going to be. What if there needs to be 2 ESOPs? What about if I got a 30% conversion on my safe, like discount on my safe? And you really do need to get that right, because otherwise you can be looking 2-3 rounds down the track and you really don't have enough equity. And the worst thing is you don't have enough equity, which sucks. And then investors don't want to invest in you because you don't have enough equity, which is like just sucks beyond, especially if you've actually achieved a few things. So be really careful with that stuff. Cool. So there's
actually a question sort of related to that. It's probably worth pulling out. In the ask, should you be detailing what ownership you're prepared to give the investor? And I think this is where, you know, for each successive round, you really only want to be, I mean, 20%. It would be a total maximum, I would think, for any particular round that you would ideally want to be diluted, especially in that seed round. So of your total round, you'd be looking at giving away 20% of the company. So the investors, you know, the valuation will kind of come out from that in terms of how much you're looking to raise and what that would ultimately mean your company's worth. But you definitely don't want to be putting a valuation or an ownership percentage within the deck. That just kind of, you know, becomes part and parcel of the negotiations around the valuation in time.
Yeah, it seems to be an in-principle sort of agreement that if you need $1 million and then you can't really be diluted more than 20%, and then the rest of it is a negotiation, and there's a lot of belief in your ability to hit your milestones. And so I think the more we can get that concept baked into the Australian ecosystem, the better, because I see all these fantastic models and all this really heavy negotiation and analysis of models. And of course, it's important to have a model, but I mean, normally you don't really know any of those numbers well enough anyway. So I think these rules of thumb are a really nice way to work it out. And I like that you said 10%. I think I used to think it was more like 20, but I really am hearing a lot more. It's in the 10% range, ideally, up to 20% max. Cool. So yeah, so get across all this.
Jace, just another follow-on question for that one as well. I had a question from Nick about, do you need to actually show the cash flow break-even point? And what happens if you actually have to raise subsequent rounds post what you're doing now to actually get to that cash flow break-even point? Is that an issue, or do I need to be able to show that, hey, I'm going to be self-sufficient at the end of this particular round?
Do you want to answer that, Lauren? So
yeah, sure.
Yeah.
I mean, one of the slides, I left out some of my slides at the end of like what you should not include, and generally financial projections, especially for that early deck, are just not useful because they're going to be largely, not fictitious, but based on a whole bunch of assumptions that may or may not come true. And in fact, for a seed round to get to break-even point would be kind of making a choice around how your business is growing. Essentially, that means you're investing in you're basically relying on cash flow to get you for the rest of the way, whereas what venture capital investors are looking for is that reinvestment in the business. So ultimately, you would be operating at what would effectively be a loss for a long period of time while you head towards that milestone that you're aiming for. So cash flow break even is not something that venture investors are looking for. They want to see a path to revenue for sure, and at some point that would flick over, but it's kind of an aspirational point on the horizon rather than an expectation by the end of kind of a round. But if you are looking to raise further capital, it's unlikely that you're going to be kind of cash flow positive at that point because you'd be reinvesting into growth.
From my experience, very, very early rounds with angels, it's very hard to put that big unicorn sort of model together and back that and show that you're going to burn through multiple rounds. I've tried that and it's really difficult to pitch that, but you kind of have to really own it. But the normal expectation is every round you get, you spend it all, and normally you'll need multiple rounds. So all that money you get will be like cumulative losses over that period. And that can go for a very long time, as we've seen with some of the biggest tech companies in the world, which can create traps in itself, but we won't get into that too much now.
And I would think seed round, you want to think about seed round as, effectively getting to product market fit. That's what that length of time is going to be, nailing product market fit and building out the product to be something that you're really proud of and can then hit the gas on the sales. The next round, Series A round, is going to be more about your growth, or maybe your pre-seed is product market fit and your seed is more about the kind of growth in the home market that you're aiming for. Series A, you're actually looking for scale into new markets across different verticals. So those are the kinds of milestones that are going to be more attractive for an investor to be looking to see you hit over time.
I love that. That was one of my big learnings when I came into the whole Startmate ecosystem, how you position your rounds and what you talk about the funding is for. Wonderful. So we've just hit our hour mark. So I really, really hope, I'm sure that was wonderful for everybody. I'm constantly impressed by Lauren and Startmate and the information that's coming out. It's a huge asset for our Australian ecosystem. And Kate's extremely thankful for everything that we are, getting from the partnership and being in the program. So definitely check it out. Stay as close as you can to Startmate crew. Thanks heaps, Lauren. I don't know if you had any final words.
Just thank you to the Cake team for making this possible. It's great to be able to share, some of these insights. As I said at the beginning, we really want to support early stage founders to get to those next milestones. So this kind of literacy in the ecosystem is absolutely key. So thanks for making that possible.
Thanks, Lauren, and thanks, Jace. Just as we wrap up, we'll shoot out a link to the recording of the webinar. So if you've missed some stuff, we went through a lot of stuff today, so you'll have the opportunity to go back over that. We'll also have some references. So if you've got, there's a couple of questions we haven't got to. If you come up with subsequent questions, feel free to hit us up, and we're always happy to actually share whatever insights we can. So yeah, awesome. Thanks very much for coming along.
Thanks.
See you all. Thanks. Bye.
There you go. Bye.